Good afternoon, everyone. Welcome to today's section on the strategic financial reporting, which is a virtual session for the workshop for finance professionals. Today is Sunday, the 27th of June, 2021, where we'll be discussing the accounting for government grants and disclosure of government assistance. And all of our discussion will be from the perspective of IAS 20. Okay, IAS 20 by its nature provides us guidance towards how we account for government grants given to various companies in order to promote such development, and also nature of government assistance that might be given, which might not necessarily be quantifiable in monetary terms, but will aid the developmental process of a company or an entity, which in actual fact impacts on the general economy as a whole through provision of employment, increase in GDP, and some other economic fundamentals. And we'll be discussing extensively based on the requirement of the standards. But before we proceed, I want one or two contributions about our understanding of accounting for government grants and assistance vis-a-vis our expectation in the course of this section. Over to any of you guys that is willing to make one or two contributions.
Okay, thank you very much, sir. Accounting for government grants and disclosure of government assistance. So this is not a standard that is very, very familiar as far as I'm concerned, but I will just talk about the little I know about it. Governments from time to time assist organizations in order to carry out specific projects. For instance, there are times that maybe during the economic downturn or some organization that government does not want to perish, they try to assist them in order to come up of their financial troubled water. So in this situation, those organizations must account for it not as revenue, but the standard provide how organizations should account for it. So it could either be accounted for as capital, like a reduction from the particular project they are using the money to finance. Maybe they are using it to finance the property, plant, and equipment. Then you have to less it from that, from the cost of the assets. And possibly another way to treat government grants, maybe I've forgotten the second way anyway. So, but I know that government grants is a very, very interesting standard, and I wish to get to know more about it, even though I don't see how very, very applicable it will be. But let's just see how it goes.
Okay, thank you very much. Any other person before we proceed?
I remember government grants. I think the other aspect is, I think you talked about using it purchase for capital expenditure where you need it, just like Chegu said. But I think the other aspect is where you recognize government grant, if it extends over a long period, then you continue to amortize it for each of the period that the government grant lasts. I think that I remember that aspect, but it's not something that I've ever used apart from the little study I did on it when I was preparing for my ECAN. After then, I've never come across government grant and its application anywhere, but I still remember that you recognize the income on them and you amortize it over the period. That's what I just remember about government grant. But I think, but with today's today's lecture, I expect to learn a lot about it.
So and something else I want to know is that the standard, is this specifically for grants from governments, or could it also be extended to grants from NGOs, grants from foundations, or grants from independent organizations that are not governments, in quotes?
Okay, thank you. I think that will lead us to discussion on the scope of the standard. Okay, as I've always said, the scope and the objective of the standard are critical for us to be able to appreciate when does this standard applies to situations or transactions. And that is very critical for us to do. Okay, now when we look at IAS 20, that speaks to how we account for government grants and disclosure of government assistance, you must understand that the standard applied in accounting for and in disclosures only for government grants and government assistance, which means that this does not apply to grants or assistance corporate, individuals, or the likes might give to non-governmental organizations, foundations alike, or charitable organizations. No, this is speaking specifically to government grants and grant to businesses. Okay, I remember we are trying to look at how do we account for activities of a business. Okay, and the information emanating from such accounting process will provide what we call financial information, which is contained in the financial report or financial statement of an entity, which various users and stakeholders make use of in forming decisions. Okay, and we need to understand how government grant may have influenced financial performance and financial position of an enterprise, such that when you are making comparison between two companies that are similar, operating probably in the same jurisdiction or otherwise, but what separates them is the amount of influence government have in one against the other through things like grants or assistance that will have formed an opinion to which decision is based upon. For example, if you have two companies competing, which company will you prefer to invest in if the two companies' performance is somewhat the same or similar, but one is enjoying government grant and assistance and the other one is not? You know that it's a matter of time that if that grant or assistance is no longer there, it then means that such company may not be able to compete effectively with the other. And that's why it's critical that apart from issue of accounting for government grants, even salient government assistance have to be disclosed so that we can make easy comparison between two entities in which one enjoys such an assistance or government grant, while the other may not. And that is that. But as we move on, we'll start to reach about conclusions that will better make us have appreciation of the essence of the standards. But as we also go into the discussion, we must also take note that this standard does not deal with some activities or some form of government involvement in the affairs of enterprise or otherwise. One of those things is one, that the special problem arising in accounting for government grants in financial statement reflecting the effect of changes, prices, or supplementary information of similar nature, which means the standard does not deal with that. Neither does the standard deal with government assistance that is provided for an entity in the form of benefits that are available in determining taxable profit or tax losses, or are determined or limited on the basis of income tax. Remember, we had extensive discussion on income taxes from the perspective of IAS 12. Likewise, let me give you a practical example. Example may include tax holidays that you arrive at through pioneer status, okay, investment tax credits, special credits, accelerated capital allowances, reduced income tax rate, and some other things. This standard does not deal with that. Why is it not dealing with that? It's not saying that it's not a grant from government, but this is more or less embedded in the requirements and provision of IAS 12, which borders on income taxes. Likewise, this standard does not deal with government participation in ownership of an entity. Where government is an equity holder in a company, that will not be treated under the standard. For example, in Nigeria, Nigerian government is into a joint venture with 3 other IOCs in the ownership structure of the Nigerian liquefied natural gas, NLNG. Therefore, this standard will not apply because such is not a government grant. It's rather government form of equity participation in the ownership of NLNG. And likewise, this standard will not cover a government grant that is under IAS 41. IAS 41 is one of those standards we are equally going to discuss as time goes on, which borders on agriculture. And a critical aspect of that is issues that borders on biological assets. Okay, and we're going to look at all of those when we get to IAS 41, which then means that the standard do deal extensively with government grant and assistance, but 4 of those items I've mentioned are outrightly excluded from the requirement of the standard. Now, let's also move further to having better appreciation of the following. Now, in our discussion, we must also understand that there are critical definitions that are essential in the bid of having better appreciation of the accounting for government grants. And we are going to look at them one by one. And in the interim, I'll just itemize them for us. Now, some of them include, we need to understand what government is so that we don't mix any form of grant that might have come from other sources to grants that came from government. We also need to distinguish between government grants and government assistance. We further discussed on issues that borders on grants related to assets and grants related to income, which form the 2 forms of government grants. And we also look at issues where government grant might come by way of forgivable loans, okay? And one thing that's also critical is issue of fair value, okay? Because measurement is involved. And one of those critical measures that we use today is more of fair value. And we need to take note of all those ones. Okay. If there's any question at this point, it will be interesting for me to hear you out. Otherwise, we'll move on by looking at the critical definitions that has been given by IAS 20. And those definitions need to be discussed extensively with the hope of having better understanding. Any question?
I have one question. You know, the other time you said this standard does not extend to grants given to NGOs, foundation, and things like that. So how do they now recognize their own grants? Because it cannot be recognized as revenue. So which standard deals with that? Or how is it treated on the financial statement?
Okay, now when you look at NGO, okay, NGO as by nature, NGO by nature, when you look at it, what is the source of contribution to NGO? Its source of contribution to NGO is a form of donation, grants, and whatever you call it. And NGO by nature does not have shareholders, rather it has stakeholders, which is more or less embellished in general public or defined public, okay? Which then means that any form of, other than subscription, other than what is defined as source of income to an NGO, capital items, which can be attributed to grants, may be considered as a form of contribution to the NGO, which forms part of the accumulated fund of NGO. Okay, but again, most grants subvention or otherwise that goes to NGOs or foundations alike goes by way of income in that period. But again, because such does not have tax consequences, you understand, there's no issue about seeing it as capital or income. But because at the end of the day, the income, once it turns out to be a surplus, once you have netted up against expenditure of the foundation or of the charity or of the NGO, will contribute to the accumulated fund going forward. And therefore, those ones are expressly stated. But we are looking at government grant that is made to businesses.
Okay.
And how do we account for such that it reflects the true substance of the transaction that has taken place between the government and the entity? Does that make sense, sir?
Yes, sir. It does.
Any other question?
I have a question. I didn't hear you clearly. Good afternoon.
Good afternoon.
Yeah. In your explanation, I didn't get something. Pioneer status, is it covered by the IAS 20?
Now we are saying that there are items that are not covered by IAS 20. Okay, part of those items are issues that border on tax breaks, whether tax breaks that emanated from reduced tax rates, whether tax breaks that comes from issue of granting pioneer status, which is tax holidays, or whether tax rates that is given a concession of paying taxes at 0% for a certain number of periods. Like, for example, if you fall under, I think, Section 31 of CETA, where you have what we call the gas utilization incentives, you also have a tax break on that. We're saying that this standard does not cover that. Rather, these are items that have been taken care of under the requirements of IAS 12, income taxes. Does that make sense now?
Yes, it does. Thank you.
Yeah. Any other question? Okay, in the absence of no question, let's look at this definition one by one. Okay. What is government in its real sense? The standard has defined government as institutions comprises of government, which means in the means of defining government, we have also included government agencies, and similar bodies, whether local, national, or international. And let me break it down. It means if you pick Nigeria as a study, executives, be it federal, state, or local government, constitute government. Other tiers or other forms of government, as the case may be, the legislative arm, the judiciary is also part of government. It could be government ministries, Ministry of Finance, Ministry of Agriculture, and the likes. It could be government parastatals, government agencies. Agencies of government may include CBN, FRS, FRC, may include MPA, and the likes. Okay. It could also include foreign governments. It could include those that are internationally recognized institutions who directly or indirectly are representing the interest of governments of a country or a region or group of countries. Example, short grant that might be received from IMF, World Bank, African Development Bank, and etc. All of these are what may be somewhat considered as government, which means grants from these kinds of institutions are what we consider as government grants. Okay, now, support from government, in line with our discussion on IAS 20, comes in two fashions. It could come by way of government assistance. Government assistance are usually by way of policy formulation, by way of government regulations, or by way of government directives or or any other mechanism. And in that regard, IAS 20 sees government assistance more of an action by government, which is designed to provide an economic benefit specific to an entity or range of entities qualifying under certain criteria. We'll get to discuss it extensively. But what that simply means is that government is putting you on an advantage in order to give you maximum support for economic prosperity. Okay, and these are not monetary supports, which means they are not support that can be quantified in money terms. But these are supports that guarantees level of your sustainability, acceptance, and probably development over time. As opposed to government assistance, what much more is visible and common are government grants. Government grants are usually monetary in nature, though there are aspects of non-monetary which we are going to discuss. But they are usually monetary in nature, which are more of physical substance. They are not by way of policy, they are not by way of regulation, they are not by way of directive, but rather by way of contributing economic value in monetary terms. And that's why IAS 20 defines government grants as any form of assistance by the government in the form of transfer of resources. Remember, I explained each of economic value. Now, they transfer economic resources to an entity in return for what the entity might have done in the past, or what the entity is currently doing at present, or what the entity will comply with in the future relating to the affairs and operations of the entity at a point in time. And the standard makes us understand that government grants exclude any form of government assistance which cannot reasonably have monetary value placed on them and cannot be distinguished from the normal trading transactions of an entity. And we're going to get there when we discuss it, which means if government is transacting business with you, buying from you, your products, that does not fall under government assistance, neither does it fall under government grants, because that's more or less emanated from a contractual arrangement. And in that situation, probably IFRS 15 will have applied with respect to revenue from contract with customers, where government is a customer in that situation. Now, furthermore, we'll get to understand that grant can be given because you have invested in an asset or you are expected to invest in an asset. Whereas grant can also be given to augment your income because of certain expenses, which are period costs that has been incurred in the immediate period. And therefore, the standard went further to define government grants as an asset and government grant as an income. Government grant related to assets is seen from the perspective where government grant, whose primary condition is that as an entity, you only qualify for this grant having purchased, constructed, or otherwise acquired an item of assets, which could be tangible and which could be intangible assets, but of which costs have been incurred or is expected to be incurred. Furthermore, there might be secondary conditions or what we call subsidiary conditions that may be attached, restricting the type or location of such an asset or the period during which such assets are acquired or held. And we're going to look at those things one after the other. which means having government grant is usually conditional upon something, whether in the past, current, or in the future, as it relates to an asset. And in that case, we'll see it as government grant that is asset related. Whereas government grant that is income related are to augment certain operational expenses or period cost of an entity in order not to have a negative impact on the company's financial performance and on its liquidity at a point in time. And that's why we define government grant related to income as government grant other than those that actually have bearing with assets. Likewise, government can give forgivable loans, and such loans are loans which the lender undertake WAFs repayments of under certain prescribed conditions. Now, for example, as an entity, we might have government loans, anchor borrower for agricultural loans, different things. I'm just giving an example. Or due to COVID-19 pandemic, if your sector is highly affected and government have to support you and they give you loan, and at the end of the day, you're unable to meet up with the loan. Under certain conditions, government want to write off that loan. That also qualify as forgivable loan under the dispensation of IAS 20. And finally, fair value remains fair value in line with our definition under IFRS 13, which speaks to the fact that it's more or less a price that would have been received by a seller to sell its assets, or that would have been paid by a borrower or an entity indebted to another to transfer its liability in an orderly transaction. An orderly transaction is a transaction where you have rational players or parties, be it the buyer, the seller, who are willing, capable, knowledgeable, and able to conduct such transactions. Okay, and that transaction is what we call orderly transaction. And as I said earlier, is a transaction that is consummated between market participants, which are the buyers and the sellers. And that must be taken at a spot, or because the price today vary, and it may not be the same as the price tomorrow or price yesterday, which then means that the measurement date, which means at what point in time are you determining this price, is critical to appreciating what fair value is. And we discussed extensively on fair value measurement under IFRS 13 in the course of our videos and sessions about part 1 to part 6 on financial instruments. You can go back and watch that also if there's a need to refresh your understanding. And that is that. Any question at this point? Any question? Any question?
So you're going to find out that any money you receive from international organizations can also be regarded as government grant. Or
no, it's not a given. You need to understand such international organization. What is their structure? If you are able to trade their structure, are you able to establish that they are related to government in one respect or the other? I've used examples like World Bank, IMF. Even though they look like conventional bank, infrastructural and support bank, but when you look at it, the primary sponsors of those banks are government of nations. What that means that any grant you have received from the likes of IMF or World Bank will much more be considered as government grant. Does that make sense?
So if that be the case, then any support from most international organizations and even domestic organizations could be seen as government grants. Because if you look at most of them, they are funded by government agencies. Almost all of them that I'm aware of, they have one or two link to government. That is where they get their funding from. So
Yes, and that's why in our definition, we use the word similar entities, including international organizations. Does that make sense?
yes, sir.
Okay. Now, can somebody more or less look at this from other perspective? Can somebody read this out?
Okay, you can see that there are many different forms of government assistance, both in type of both the type of assistance and the conditions attached to it will vary. Government assistance may have encouraged an entity to undertake something in it otherwise would not have done. How will the receipt of government assistance affect the financial statements? An appropriate method must be found to account for any resources transferred. The extent to which an entity has benefited from such assistance during the reporting period should be shown.
Okay. Now let's go in depth to discussing on this.
I don't know if I can just quickly ask a question.
Yes, sir.
Okay, like what if there's a clause in the grants that has been given to an organization that if that organization could not meet up with certain things, then it will have to refund the money back to government.
Yeah, we are going to that's going to be the last aspect of our discussion.
Okay.
Repayment of government grants due to the fact that certain conditions are not met.
Okay.
How do we treat that? And that's why we also speak at the beginning to say, okay, the grant given to you, is it a grant to support the assets or grant related to income? And the difference is that grant related to income had no future condition to be met, which means it's more or less like, it's like a dash. Do you understand? And once you take it, it has gone. While the one related to assets might be that, okay, yes, you have bought the asset, but you must ensure you continuously use this asset and you maintain it at a certain level. And the time you more or less fail to meet those conditions going forward, might call back for the grant or part of the grant. And at that point, it brings about repayment. How do we treat that? Those are things we are going to discuss in the course of our discussion. Now, let's look at this with respect to government grant. Now, remember, we have understood what it is now. But again, at every point in time, you must distinguish between government grants and government assistance. Now, we are not going in depth to discussing on government grants. Okay, who will assist me?
Okay, let me read it. Government grants. An entity, I think that's a portion, but there's a little noise in my background. I hope it doesn't disturb.
Okay,
so
you can
an
assist.
entity, okay, an entity should not recognize government grants, including non-monetary grants at fair value, until it has reasonable assurance that one, the entity will comply with any conditions attached to the grant. Two, the entity will actually receive the grant.
Now, take note, these
As we
conditions
receive,
are sacrosanct to recognizing government grants, which means whether government has handed over the money to you or not, if you know that the conditions attached to it are unlikely to be met, therefore, you will not be able to recognize that government grant. Even if you have received it, just treat it as a payable or refundable amount to government. Do you understand? Because it will not be reasonable for you to have recognized what you know at the end of the day, you have to refund due to one reason or the other. And second one is that even when you have met this condition, but again, you know that sometimes, especially government of the developing world or the underdeveloped world, you might enter one chance by way of just ordinary hearing commitments. And when it now comes to get the money, story will come, government will change, and all sorts of things comes in. I have proceeded in recognizing, which means issue of evaluating the capacity of the government and the ability of the government to pay you and for you to receive that grant in cash or in its equivalent, whatever it may be, must also be ascertained before you venture into such a recognition. Can you proceed, sir?
Okay. Even if the grant has been received, this does not prove that the condition attached to it have been or will be fulfilled. It makes no difference in the treatment of the grant, whether it is received in cash or given as a reduction in a liability to government, i.e. the manner of receipt is irrelevant. Any related contingency should be recognized under IAS 37, provisions, contingent liabilities, and contingent assets once the grant has been recognized. In the case of a forgivable loan, as defined in key terms above from government, it should be treated in the same way as a government grant when it is reasonably assured that the entity will meet the relevant terms for forgiveness.
Thank you very much. Now, having done that, the first step is identify whether we actually have a government grant. Now, if that has been established, the next thing is, how do we account for such a grant? I'll now come here. Accounting, treatment, of government grants. Now, later on, we are going to see two perspectives to accounting for government grants, but let's just look at the narratives before we proceed. Okay. Madam Anne, we want to hear your voice.
Okay.
It seems your network is poor.
Accounting treatment of government grants. IAS 20 requires grants to be recognized as income. Okay.
I think your network is poor. Can Shegun take it up from there?
Okay. Accounting treatments of government grants. IAS 20 requires grants to be recognized as income over the relevant periods to match them with related costs which they have been received to compensate. This should be done on a systematic basis. Grants should not, therefore, be credited directly to equity. It would be against the accrual concept to credit grants to income on a receipt basis. So a systematic basis of matching must be used. A receipt basis would only be acceptable if no other basis was available. It will usually be easy to identify the costs related to a government grant and thereby the periods in which the grant should be recognized as income. That is when the costs are incurred. Where grants are received in relation to a depreciating asset, the grant will be recognized over the period in which the asset is depreciated and in the same proportions.
Okay, now what we are trying to explain here is to look at it from a perspective of you have gotten a grant. Let's say you've gotten a grant of 10 million naira. If the grant is on the premise that government want to support you for what you've done in a particular period, in which there's no future condition attached to it, once government gives you the reasonable basis to recognizing that grant is to recognize it in that period, only in that period. But there are also instances where government gives you a grant on the premise that you have done something, but that's something you've done, they also expect you to continue over some period in time, which means a condition is attached for you to continuously enjoy that grant, even though it might have been paid in full as of today. The question then is, if 10 million that was given to me is on the premise that I continue to deploy the assets for the next 4 years, what then comes to my mind is that the 10 million you are giving to me, I have to recognize that 10 million on a systematic basis over a 4-year period. But the question then is, on what basis? Now, the basis, based on the guidance given by the standard, should be more or less in tandem with the basis to which that asset has been employed and the cost of that asset has been recognized by way of consumption in the books. Practical example is this. If government gives you grant for you to be able to deploy an asset that must be put to use for not less than 4 years, and which means if the economic life of that asset is 4 years, and you are depreciating that asset, let's say 50 million is the worth of the asset on a straight line, it then means that it's also reasonable to recognize the grant by way of amortizing it as an income on a straight line basis over 4 years. If you have used some of the year digits to recognize the depreciation on the asset, you also use some of the year digits to recognize income on that grant. Does that make sense, please?
Yes.
Okay, if it makes sense, now what I'll also do is for us to look at this question, and I'll leave it to you guys to help me prefer suggested solution to it. Okay, let's look at this. Can somebody read the question? And I'll give you a few minutes to liaise with one another and provide solutions to it.
Okay. Arturuco receives a grant. Arturuco receives a government grant representing 50% of the cost of a depreciating asset, which costs $40,000. How will the grant be recognized if Arturuco depreciates the asset A over 4 years straight line, or B at 40% reduced balance? The residual value is nil. The useful life is 4 years.
Okay, who will guide us? Who will guide us in this?
Okay. The asset cost $440,000, and Arturuco is entitled to 50% of the cost of the asset. And the useful life of the asset is 4 years. And on A, since the assets will be depreciated over 4 years, that means the 50% income of that is the value of the asset, which is $20,000, that will come from the government, will be recognized over a 4 years period. That means $20,000 divided by 4, that is $5,000 will be received into the income statement every year, while the balance will be regarded as as I forgot how you use the balance will be what would you carry it as? I think
Carrying amount.
Pardon? I didn't get that.
I thought you wanted to say balance would be the carrying amount.
No, I was saying that if you recognize $5,000 out of the $20,000 that came in the first year, you have a balance of unutilized $15,000, which will now be. So basically, every year. So how do you carry it? You have to. It has to be on the credit side of the balance sheet. The $50,000. That's what I was trying to say. That you amortize it over 4 years. That is where I look at it. Then for B, I don't know. Somebody else can say something on that. I think I've tried.
Okay, for the B, it says at 40% reducing balance. So from that 20,000, which is half the cost of the assets, so it means at every year we will charge 40% of the carrying amount. For instance, in the first year we charge 40% of 20,000. Then the net book value for that year will be the 20,000 minus 40% of 20,000. So in the next year also, whatever is remaining, we charge another 40%. And that is how it will continue until the entire $20,000 has been completely expensed to the income statement.
Madam Grace, can we hear you out?
Yeah, they've said the preferred solution to it. That's my understanding of it. Like the A, 50% of the cost of the depreciable asset of $40,000 will be shared over the period of the useful life, which is 4 years, which will be 10,000. And at the, charging 10,000 at the first year, the 30% to be carried, the 30,000 will be carried for the following year, like that till the whole useful life of the asset. Then for the B reducing balance, which is 40% of the 20,000, which is 8,000, will be charged the first year. Then 8,000, take away 8,000 from 20,000, will give you 12,000. Then the second year, 40% of the 12,000, like that till the whole amount is exhausted. That's the reducing balance.
Thank you. How about Anne? Okay, Anne, can we hear you? Anne? Anne, we can't hear you. Okay, let's move further. Now, last time, attempt solving this problem. Let me switch to our exam model. Now, what do we need to do? Is for us to look at the two methodologies. Cost of assets, $40,000. Grant given to us in percentages. Government gave you grant that once you buy this kind of assets, you get 50% of the cost as grants. Okay. Useful life of assets, 4 years. Okay, what else? Method of depreciation. Straight line. And using balance. Now, straight line, the rates. If you remember the formula, it will be 100 divided by 100% divided by the number of years. That automatically gave us 25%. While it is in balance, the information was given to us on a platter of gold. We said 40%. But again, if you remember those days, you can determine the reducing balance using the appropriate formula. Okay. Now, the question then is, okay, we are given residual value. Is 0. All figures are in dollars. Now, let me now pick it one by one. Method 1, straight line. How much will be depreciated from the assets? And how much are you going to release on a systematic basis as the income? I'll call it grant income. Now, yes. Year 1, year 2. Year 2, year 3, and year 4. Calculation. Now, for the depreciation, what formula will I use? Is the 25% fixed rates times the $40,000. Why for the grant? I'll use the same 25%, but multiply by what is the grant amount?
20,000.
Now let's look at the grant amount. The grant amount, remember, we are told 50%. It's not absolute amount, it's a percentage of your investment. 50% of how much we invested, 20. Therefore, let's take note of this. Therefore, I'll come here to say net of 20,000. Now, all what I'm doing here, I don't need to do it. Okay, once I've done it on Excel linking, writing it out is just for your understanding by the time you are practicing. Okay. Now, what is the product? 25% of this. And this amount is constant because it's a straight line basis. And therefore, this is what I recognize in year one. In year two, in year one for grants, it's still the same 25%, but the amount of grants, which is 20. And this is what I'll do because it's straight line for the next 3 years. And that is, as I'm recognizing depreciation as a charge to my operating expense, I'm releasing the grant into my income statement. Net, the net effect is that my profit or loss is only impacted. My profit or loss is only impacted with the net amount, which is the difference between the expense and the income. Does that make sense?
Yes.
Okay, now let's try and replicate it for year two. In year two, I'm going to tweak it somehow. Sorry, not year two, in the method two. I'll tweak it somehow. I'll try to create my net book value. Now, okay. Now I pick it one by one. In year one, okay. What is the depreciation? 40%. 40% of what? The initial 40. Okay. At end of year one, we'll come there. Now, 40% of 40. Okay, the same thing. I do 40% of 20. Now, there are two values I'm going to create. This is net book value, which is for the assets. Let me shorten net book value. Assets. And now do ground balance. At the end of. Okay. Now, if I do that 40%, of 40,000 give me 16, and 40% of 20,000 8. Net. What do you have? You have 8,000. Now, in year two, it will be 40% of the balance in year one. And what is balance in year one? Initial 40 minus amount of depreciation. For grant, initial 20 minus amount of amortized grant income, which means in year two, I have to recognize 40% of 24 and 40% of 12. And how will I do that? I come here, %,
of 24.
%, of 24 will give me 96, and 40% of 12 will give me 48. And therefore, my new balance will be the difference between this 24 and this 96, and the difference between this 12 and 48. I'll repeat the same process for year three. but now it's 40% of 14.4. And 40% of 7.2. Therefore, what do you have? Have 40% of 14.4. You have 40% of 7.2. Now, using balance method, the last year will just be the balance in order to capture the rounding error. And that's why last year we just pick balance net of residual what? Value for depreciation. And in that case, what is the balance here? The balance here would be this amount net of residual value, if any, which means everything is 864. And likewise, for grant, it will be balance on grants. And in that case, the balance on grants, you don't deduct residual value because the grant has been enjoyed in full. And that is that. Where you see difference is that if I change it now that I have a scrap value of $1,000, you see the effect of it. It will not affect the grant, but it will affect the depreciation. Does that make sense? No? Okay. This method is method 2, reducing balance. Any question? Any question? Does that make sense now? Now let's go back to our notebook. If I can put the answer there for reference words. Any other question?
No question.
Okay. Now let's take note of this. Can somebody read this out for us to support what we have done?
Okay, I'll read. In the case of grants for non-depreciable assets, certain obligations may need to be fulfilled, in which case the grant should be recognized as income over the periods in which the cost of meeting the obligation is incurred. For example, if a piece of land is granted on condition that a building is erected on it, then the grant should be recognized as income over the building's life. There may be a series of conditions attached to a grant in the nature of a package of financial aid. An entity must take care to identify precisely those conditions which give rise to costs, which in turn determine the periods over which the grant will be earned. When appropriate, the grant may be split and the parts allocated on different bases. An entity may receive a grant as compensation for expenses or losses which it has already incurred. Alternatively, a grant may be given to an entity simply to provide immediate financial support where no future related costs are expected. In cases such as this, the grant received should be recognized as income of the period in which it becomes receivable.
Okay. Thank you very much. Now, let us now look further to have discussion on non-monetary grants.
Okay. I want to answer a question. Hello?
Okay. Proceed, sir.
So basically, the grant that has come in, so we recognize it. How do we capture it on initial recognition? Is it on income received in advance, or how do we, or initial, before we begin to amortize the grant? Because that's still liability.
Okay, you recognize the grant at the amount in which it is granted. And what does that mean? If the grant has been given to you today in monetary terms, what is the cash value of that grant? If the grant is given to you other than in cash, which is a non-monetary grant, we recognize it at fair value. And later on, we'll discover that where fair value might not be obtainable, we might recognize it as a notional amount. Okay? Which means first is the cash value, which is what government has handed over to you, or what they are expected to hand over to you, if it's not more than 1 year. But if it's more than 1 year, remember the time value of money may set in. You understand? But again, if it's more than 1 year, I don't think you'll be able to recognize, because it may not have met one of those conditions on the premise that, are you sure that this may be received? Okay, especially in this part of our own world. Okay, but as I've said, otherwise, if it's for non-monetary grants, it will be recognized at fair value of the non-monetary item that has been given by way of grant. And if fair value cannot easily be ascertained or obtainable, a notional amount will be used. Well, let's move further to discuss on it.
Please, I have a question.
Yes, sir.
Okay, in a situation whereby the grant is coming as a form of reparation for whatever reason, maybe government had encroached into the organization's land, or for whatever reason that government need to make reparation, and government is paying a huge sum of money to the entity, will that still be recognized as government grant or other income?
Okay, you need to understand something here first. If government is giving you compensation, it means you've lost something, which means you'll have recognized that loss in your books. And you are going to recognize what government has given as compensation as income. You understand what I'm saying now? Because government compensation for what you might have lost in material terms or otherwise will not necessarily be considered as government grants, because there's no condition there. Government wants to build, extend roads into 5 lanes or 10 lanes, and they have to demolish my house. You understand? They demolish part of the property of the company. You know that you have to write off that property in your books. And therefore, as you write property in your books as write-off, you use a compensation, which is the money received from government. And what that means that impliedly, there's a deemed disposal of an asset that has created a loss or profit or gains on disposal, depending on whether the compensation is more than the value lost or is less. Does that make sense?
Yeah.
Okay. Now, can somebody take us through our discussion on non-monetary? Non-monetary comes with respect where, rather than government giving you money as grants, they give you rather assets as grants. When I say asset, probably government give you land, government hand over equipment to you, and etc. How do you recognize that, and on what basis do you measure it, which will support what I've told you earlier? Can somebody take it up?
Okay, let me read it. Non-monetary grant. A non-monetary asset may be transferred by government to an entity as a grant. For example, a piece of land or other resources. The fair value of such an asset is usually assessed, and this is used to account for both the asset and the grant. Alternatively, both may be valued at a nominal amount. Measurement of non-monetary grant. If a government grant takes the form of a non-monetary asset, such as land or other resources, it is usual to account for the grant and the asset at fair value, IAS 20, section 23. Fair value is defined as a price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. See IFRS 13 fair value measurement, IAS 20, section 3. Note, however, that the recognition of non-monetary grants at fair value is not mandatory. IAS 20 allows as an alternative treatment that the grant and the asset be recognized as a nominal account, IAS 20, section 23.
Thank you very much. Okay, now we'll now look at how do we present grants that is asset related. A grant that is asset related means the grant is given to you in fulfillment that you have purchased an asset or you purchase an asset that will be used over time. Which means that invariably you cannot recognize such grants as income at once. Rather, you recognize that grant initially as liability, and by way of systematic recognition and allocation, you amortize that grant over that period of time in tandem with the use of that asset or condition in a systematic way, which we have demonstrated whether by a straight line, some of the digits or otherwise, and you now recognize it over time. But there are two ways to which you can present the effect of that recognition. The first aspect is that you can present it in such a way that the grant is recognized as a liability separate from the assets. And such grant will be recognized as a form of deferred income. And you can describe it in your notes or even surface of the account as grants, government grants. The second approach, okay, that approach might be called gross basis or capital approach in some quarters. The second approach is that rather than show the liability separate from the asset to which the grant has been given, you report both net. What it simply means is that if you bought an asset for 20 million and government gave you grant of 8 million on that asset, rather than show the asset in your books at 20 million and show the liability with respect to that grant at 8 million, you net it off and show the asset as if you bought the asset for 12 million. And that will not show the liability side, we only show the asset side, but the liability has been offset with the assets, and the asset will be shown at 12 million. But there are arguments for and against that approach, which is the second approach. One of the arguments is this: showing that asset in your balance sheet to stakeholders at 12 million may have misrepresented the true value of that asset. But the argument that favors it says that no, you have not, because you have sufficient information that has provided the value of the assets and likewise the value of the grants. Second, there's an argument against it to say that when you look at it for analysis and decision making, you may have misrepresented most of the facts relating to the asset and the performance of position, and equally it could affect some ratio analysis and some other things in which decision might be taken by stakeholders. But again, the argument in support is this. Most times, if not for the government grants, some companies may not have invested in such an asset, which means the grant is a condition that has aided the commercial substance of even acquiring such an asset in the first place. The question then is, when you look at it in principle, it then means that the second method equally makes sense, as the case may be. And so far there is sufficient disclosure for analysts or whoever can always restate the position to carry out his analysis, which then means that henceforth, up to today, the board, which is the IAS, has supported the two methodologies, which means the second methodology is more or less what we call like the approach where we try to show it on a net basis rather than on a gross basis with respect to the asset. Now, let's speak to the fact. Now, the position of standard, as I've said earlier, there are two choices. And one is to set up a grant as a deferred income, which means in this case, you treat as a liability. While the second one is that you net it off or deduct the grant from the cost of the asset before arriving at the carrying amount, which means rather you net off against the cost of the assets. Now, these two methods are considered acceptable and considered alternative methodology from the perspective of the standard. Now, let me now give us an exercise, and I want you guys to provide a guidance to solving the problem. I want somebody to read it and provide us a guidance to solving it. We are going to make use of the two approaches in the course of solving it. Who will volunteer?
Okay. A company receives a 20% grant towards the cost of a new item of machinery, which costs $100,000. The machinery has an expected life of 4 years and a nil residual value. The expected profits of the company before accounting for depreciation on the new machine or the grants amount to $50,000 per annum in each year of the machinery's life.
Okay. Now who can give us a guidance to that? Who can guide us?
Okay, I can try.
Okay.
Okay, what that means is that we have the cost of the asset to be $100,000, and we have 20% grant on it, which is $20,000. There is no residual value. So in looking at the first approach, which is the approach whereby we recognize liability, and we then have to charge the relevant amount into P or L based on the number of years of that asset. So that means that we recognize $20,000 as liability. And in the first year, since it is 4 years, the asset is to last for 4 years. So in the first year, we'll charge $5,000 to income statement, as income, and we recognize liability of $15,000. So that will continue until the 4th year. And for the second approach, which is the approach of netting off, that means we recognize value of PPE of $80,000 on the balance sheets as a cost of the assets in the first year.
Okay. Is that all? Is that all?
That is all I can say for now. Though I'm seeing
Okay,
I'm seeing the income. I mean, the profit of the company as 50,000 per annum, but I don't know how I'm going to incorporate that into the calculation.
Okay, in terms of the profit, let me just come in. For the first approach, the depreciation value, the net depreciation value would be $15,000 because it's going to be depreciated for a period of 4 years. I think it's 4 years. And let me see, the 4 years, yes. So therefore, the machinery will be depreciated for 4 years. That is $25 per year for depreciation. So by the time you net off the $5,000 from the grant, you have $20,000 depreciation. So by the time you deduct it for 50,000 naira, $50,000, you now have annual profit of $30,000 for each of those years. That's on the first one. Then on the second one, I think it's going to have the same impact on the profit.
Okay. Thank you very much. Okay. Now, the only information we have primarily was information about straight line method. We don't have information about reducing balance. Okay, but I'm just putting it there. Let me change the color. I'm putting it there just for knowledge sake to see how it also affects. But our solution is strictly on straight line. Therefore, this is what will have come out on the straight line. Okay, and the only thing that is different here is to change what is in there. Okay, and now this coincidentally was 20 because it is 20%. That was the percentage of the grants. Okay, therefore I can use that to replace. And when you check it again, this is 25% of the 100,000 is this, and the grant is 25% of the 20,000 is this. And the net effect is that you are only depreciating the assets for 80,000 because you have netted 100 against 20. Okay, now what we are interested here is how do we present? Okay, now the presentation will come in this way. Method of presentation. Where grant is treated as a liability, deferred income. How do we do that? Step one is the initial recognition. at the commencement of the grant or at the grant date. Let me just put at the grant date. Okay, the grant date in this case probably is beginning of year one. What do? Debit our bank for the receipt of cash, we credit grants, government grants, liability, and we describe it as what? Government grants. And if you don't describe it as government grant, but rather you describe it as deferred income, in your note, you go and disclose it extensively. Even with this, you are still going to disclose in your notes the nature of the grant, what brought about it, what condition, how you enjoying it, what value will it bring, and all sort of information. In that case, we have the debit and we have the credit. How much? 20,000 and the corresponding credits. And the narration will be being the value, the monetary value of the grant received from the government in relation to the acquisition and use of a power plant. Let me just put it like that. Did they give us the name of the item? What did they buy? It's okay, machinery. A power plant is also a machinery. A power plant which must, that's the condition that must be used for 4 years. Okay. That is that. Now, step 2. Is for us to more or less show financial performance impact of extract. Remember, your financial performance is with respect to your profitability. It's the same thing as income statement or statement of profit or loss. Now, in that regard, we'll look at the years. I think I have 4 years. One, two, three, 4. And probably I sum it up to see the total effect over a 4-year period. Now, estimated profits this profit was considered as if it's the actual profit for each of those 4 years. Remember, it was estimated and given to us on a platter of gold, which means over a 4-year period, our profit should have been about 200,000. Now, these profits, we've not considered the effect of depreciation, because if you read the information, it says the expected profit of the company before accounting for depreciation of the new machine or grant. This means we can say this is profits. Let me just call it EBITDA. Therefore, you know what EBITDA means, earnings before interest, tax, and depreciation. Let me now less depreciation. Remember our depreciation? Our depreciation is, okay, I won't be able to transpose it because it's, there are breaks in between. Therefore, let me just pick it one by one. Remember, these are depreciation for each of the years. Now, that depreciation is augmented or offset by the grant income as amortized. I put that in green. How much was that? Close the gap, drag it back. Okay, which means net, what will be my impact in profits? And that is it. It means as I depreciate the assets, I also recognize an income. And that's why I call it an income approach, where liability is recognized, or a gross basis, where liability is recognized separately. Okay, now let's look at the second methodology. The second methodology, with respect to presentation, is grant treated as an offset to the cost of assets. This is what in some quarter they call income approach. Why this is in some quarter they call capital approach. Now, what is the capital approach? The same recognition principle for the cost of the asset, the grants, but rather instead of the grants to be treated as a liability, the credit will go to the asset account. Which means once it goes to the asset account with a description of net off or reduced as a result of government grant, the book value of the asset may be 80,000. At that point, what will happen is that this calculation we did will no longer be relevant. What will be relevant is what you see here now. The calculation relevant now, let me unmatch and delete all of the sections that have no bearing with, that has bearing with the grant. Therefore, what happened is you are now looking for 25%, not of 100,000, but 25% of the net, that is asset costs, net of government grants. Now, what is the asset cost net of government grants? Original cost of the assets less government grants. You bought the asset for how much again? 100, and there's a grant of 20. Passing this entry here against asset it means, what it simply means is that you are reducing this value of the assets by 20. Therefore, I'll pick the cost, 100, and I pick the grants. And in that case, what is the net amount? The net asset cost. Now, which means depreciation will now be based on 80,000. Let me asterisk it. I'm not on 100,000 across board. And in that case, what will happen is we'll now base it on this 80. And that's how we depreciate it. You now find out that at the end of the day, your sum of impact in depreciation is 80,000, which is synonymous to the same net effect here. 100,000 depreciation, 20,000 income. When you net it off, the impact is also 80. Now, how does that affect our presentation? Now, here we won't have grants. We only show depreciation. And in that case, what's our depreciation? 20. 20. It looks the same because we are using straight line method. If we have done otherwise, and that is it. And as such, I see my presentation in the same manner. And this is with respect to financial performance. Let me show you how it affects my balance sheets, which is step 3. Step 3 will deal with balance sheets. My statement of financial position extracts. And what are the items I have? Non-current assets. In this case is property, plants, and equipment. Now I have the cost of the property, and I have my, instead of depreciation, okay, I can have my depreciation. This is cost or net book value, which is the net value. Let me use the approach of net book value. Now, at that point, I don't need this. Okay. Okay, what is the initial cost? The initial cost for this was 100. Remember, for the approach we are doing, it's 100. It's 100 because we didn't net it off. Now, the depreciation, if you remember, is here. And we can drag it for the 4-year period. And the sum. I remember your net book value at the end of year 1 is your brought forward balance in year 2. And at the end of the day, in year 2, we have 50,000. And by the time you do that for year 3, year 4, the assets will have been fully depreciated. And that is it. The same experience here is what we use for method 2. In method 2, the cost is not 100,000. We are going to pick the net cost of 80,000 because that is what we are reflecting in our balance sheet. And we recognize 20,000 depreciation over years. And that is it. Does that make sense? Does that make sense to us? Okay.
Yes.
Yeah, thank you. That is that. Now, what I'll now do is that this method 2, you go and replicate it at your own end. That is, what if it's not straight line? If it has been reducing balance, how would that have affected our, how will it have affected our, what's it called? Our presentation. Does that make sense to us? Now I can copy the solution. And take us back to where we are coming from. suggested solution. Any question? Any question? I can't hear you guys talk.
No, no questions, sir.
Okay. Now we'll look at other aspects of the requirements of IAS 20.
Come here.
I have a question. Hello, Mr. Muyiwa.
Hello, ma. I can hear you, ma.
I have a question. The method 2, since we will not be showing the liability first, we will do the method.
I didn't get you.
Won't that warrant us, as in for the method 2, which is method?
Okay.
The
The
method,
method, no, method 1. It's not method 2. The income approach. Okay, we didn't show the liability.
Okay.
Thank you. Now let me show the liability.
Okay.
Therefore, our liability side, non-current liability. Under that, you put deferred, or let me just put government grants. In my liability, see what I'm going to do. And I hope it will not shock some of you, because you might have expected otherwise what you will see now. Now, in my first year, my liability will be the balance. Remember, out of the 20, out of this 20, I've already enjoyed 5. Therefore, what is left as liability will be 15. And it is not current liability because I still have 3 years to go. The balance in year 1, I deduct the portion already recognized in year 2 as income, and my balance in year 2 will be 10,000. By the time I get to year 3, it is 5,000, which is the balance to be enjoyed in year 4. Which then means that in year 3 is no longer current and non-current because it remains 1 year to go. Therefore,
can you show the Excel screen?
Okay, sorry, I didn't show you the Excel. Oh, sorry. Now, this is what, let me start all over again. I created these additional lines. Now, we want to show the liability side for the grant. based on method 1. Remember, method 1 says grant is treated as a liability. Now, initial liability was at the beginning of year 1, but we are presenting financial statement at the end of year 1. It then means the initial liability at the beginning of year 1, the 20, less the portion that has been amortized as income in year 1. And that gives me $15,000 left. In year 2 is the balance in year 1 less amount that has been released into profit or loss as income in year 2. That is 10,000. By the time I do that and I drag it for year 3, what will be left is 5,000. But between year 1 and year 2, this amount is due for more than one accounting year or more than 12 months. That's why it is non-current. But by the time you get to end of year 3, the 5,000 is due in the next 1 year, which means it's no longer non-current, but rather what? Current. Which means in that case, I'll take it as what? Current in my balance sheet. And by the time I get to
Mr. Weaver,
yes, ma'am.
please, the second year when you have the $10,000, 5,000 there is non 5,000 is current and 5,000 will be non-current. Why are we represent? That's my thinking.
Yeah.
So why are we treating the 10,000, the whole of 10,000 as non?
Yeah, you know, that's the approach I'm also saying that it might shock you guys, because what you'll have expected that I can say current portion, non-current portion.
Non-current portion.
I can do that, and likewise, I can do this. The reason why I may do this and it's acceptable is because, one, that grant is repayable peradventure I'm unable to meet up again. You know, there are conditions attached to it. Okay?
All right.
That's why I said I might shock you guys. Okay?
No,
Which
you
I've done.
are in line, sir.
Now, I've done that. Since I've shocked you, I can now go back to the convention. And what is the convention? Now, let me go back to the convention. This is 15,000. This 15,000 is not the non-current liability, but rather the balance of the grant as a liability, which I now have to split between current and non-current. Now, since I know what my current portion will be each year based on the amortized schedule, which is 5,000. Therefore, that 5,000 that will be due in year 2, I'll bring it down so that this 15,000 will now be net off this, which means I now have the current portion of 5,000 and the non-current portion of 5,000. By the time I get here, I do the same thing. But in this case, it will have been this amount minus this 5 in year 2. But because I have 5 in year 3, the 5 in year 3 will be the current portion. And the difference between the 10 and 5, which is 5, will be the non-current portion. And I'll do this, sorry, I can drag this and do it for the whole remaining period. And the remaining period, you'll find out that there's nothing due again as non-current portion. Do you get what I'm saying now? Why the current portion is 0? Because it's picking this 20 because I put it side by side. But if I've taken it out, like this, by the time I drag, it will have picked 0. Are you getting the logic now? Therefore, I can come here to do it myself. This is 0 because there's nothing left. And this is a 5,000. And this also is 0, nothing left. Everything has been amortized in your profit or loss. That is that. And I think I've been able to achieve my objective. Let me just copy this and go back to replace it in my workbook. Okay. Any other question? Now I want you to read this out to substantiate some of the things we've done so that we can move on from there. Okay, who will assist us?
Okay, whichever of these methods is used, the cash flow in relation to the purchase of the assets and the receipt of the grant are often disclosed separately because of the significance of the movement in cash flow. Deducting the grant from the cost of the asset is simpler, but the deferred income method has the advantage that the non-current asset continues to be carried at cost in the financial statements.
Okay, thank you very much. Now, let us now look at presentation. Of grants related to income. We know the one we just finished is the one related to an assets. Now, the one related to income is straightforward. Why? Because there's no future condition attached to it for it to be fulfilled. Rather, the entire amount of the grant will have been recognized in the period as an income or as a reduction, which is offset against the respective expenses. Now, let's see what has happened. Can somebody read this out for us?
Presentation of grants related to income. These grants are a credit in profit or loss, but there is a choice in the method of disclosure. A, present as a separate credit or under a general heading, e.g. other income. B, deduct from the related expense. IAS 20, paragraph 29. Some will argue that offsetting income and expenses in the statement of profit or loss is not good practice. Others will say that the expenses will not have been incurred had the grant not been available. So offsetting the two is acceptable. Although both methods are acceptable, disclosure of the grants may be necessary for a proper understanding of the financial statement, particularly the effect on any item of income or expense which is required to be separately disclosed.
Thank you. Which means is either you show it as an income in the profit or loss, similar to what we've done here, grant income, along with other income, and depreciation has gone to where it's supposed to be, or if it's any other expense. Or you show it net, whereby you are seeing depreciation as 20,000, but actually it's 25,000, but has been augmented or offset by 5,000 income. That's how we have 20,000, and that's what we are trying to speak to. There's something that Shegun raised concern about. What if, as time goes on, you're unable to meet one or two or more conditions attached to that grant? What happens? That led us to repayment of government grants. Now, what happened in such a situation is that if a grant must be repaid, it should, by nature, bring about what will have happened by nature is you will treat it as if you are not going to take it as an error, but you are going to treat it as if there was a change in the basis of an accounting estimation. And that will be in consonance or in line with the requirements of IAS 8. And what that means is that you are going to treat such a repayment as a change in an accounting estimate that requires a prospective accounting to effect such change, which means you will not go back to restate your account as if there was an error, but rather you are going to prospectively apply it as if what you have eaten before, probably you are now paying it back today. And invariably, what you then do is as follows. One, if the repayment of the grant is related to income, what you do is to first apply against the balance left in the liability, that is in the grant account. Okay? But if the balance in that account is not enough to absorb all what you have to repay, the remaining will now be charged as an expense, as if you are incurring an expense in which you have to pay government on in the current period. The second aspect is if the repayment of the grant is related to an asset. What then you do is that you will go back and increase the carrying amount of that asset. You know, we reduced the carrying amount before. Now you have to increase the carrying amount of the assets, which invariably will more or less like we are restating the assets, or you reduce the balance in your deferred income. If you have used this, what's it called, the first methodology for presentation. Now, what then happen is that the cumulative additional depreciation that will have been recognized up to date on the premise that that grant shouldn't have been given will be immediately recognized in the current period. What does that mean? Let me go back to the example. Now look at it. Let us assume that in year 3, we missed the condition going forward. And government.
Your screen, please.
Okay. In year 3, let's say we missed the condition and we have to return the whole amount in full or in part to the government. Now let me assume that we are returning the whole amount. The whole amount of the grant is $20,000. Now, if you check, the net effect of our assets, where's it? Let me use the net book value one. The net effect on our asset was that my assets in the balance sheet was showing 20. But if I have not applied that discount, that deferred income, grant income, my net assets will have been 25. Is it 25? Yeah, that's 100. And it will have been 25. But my net assets is what? 20. Therefore, there will be an additional depreciation between the difference of 25 and what? 20, which I will now have to recognize in that respect. Do you get what? In order to restate it, such that at the end of the day, instead of having 20 carry forward, I'm now having 25, which will be in tandem with the last year depreciation. And that is what we mean by that. Okay, which that means that if I come back here, we can now see the position as it is in tandem with the standard. Can somebody read what the standard requires of us to do to corroborate the
Okay, let me read it. Repayment of government grants. If a grant must be repaid, it should be accounted for as a revision of an accounting estimate. See IAS 8. A. Repayment of a grant related to income. I apply first against any unamortized deferred income set up in respect of a grant. Any excess should be recognized immediately as an expense. B. Repayment of a grant related to an asset. Increase the carrying amount of the asset or reduce the deferred income balance by the amount repayable. The cumulative additional depreciation that would have been recognized to date in the absence of the grant should be immediately recognized as an expense. It is possible that the circumstances surrounding repayment may require a review of the asset value and an impairment of the new carrying amount of the asset.
Yeah, what that also says is that it goes beyond what I've shown you or have done. That this can also trigger that maybe the use of that asset might have more or less bring about obsolescence and some other things that might require an assessment for impairment. And in that case, impairment loss may further be recognized to reduce the carrying amount of the assets, even when you've restated it based on the revision to the estimation. Okay, now let's now look at government assistance, totally different from what we have discussed so far with respect to government grants. Remember, we've defined what government assistance is. And government assistance is usually triggered or actualized through policies, regulations, directions, and some other things. Government will assist you by putting tariff on foreign products or ban foreign products so that you can be able to sell more, or use quota system and some other things. Now, what do you do with respect to that? How do you account for that? Okay, Shegun. Over to you, Shegun.
Okay. Government assistance. Some forms of government assistance are excluded from definition of government grants. A. Some forms of government assistance cannot reasonably have a value placed on them, e.g. free technical or marketing advice, provision of guarantees. B. There are transactions with government which cannot be distinguished from the entity's normal trading transactions, e.g. government procurement policy resulting in a portion of the entity's sales. Any segregation will be arbitrary. Disclosure of such assistance may be necessary because of its significance, its nature, extent, and duration should be disclosed. Loans at low or zero interest rates are a form of government assistance, but the imputation of interest does not fully quantify the benefit received.
Okay, thank you very much. Now, government assistance are only disclosed with respect to the nature, the possible effects, and circumstances surrounding such an assistance, and how long such an assistance is expected to be in place, and what other things are more or less put as strategy to more or less ensure that peradventure, if such an assistance is no longer available, how do you ensure continuity or sustainability of your business? And that is that. Okay, now there are special things I would like us to look at before I end it up with disclosures. Okay, and one of those things is government grant related to agricultural business are outside the scope of this standard. Why? Because that is specifically taken into consideration and accounted for under IAS 41, which we are also going to take into consideration. Okay. Any question before I proceed?
I just want to look at this scenario. For instance, there are times that government sell its facilities to businesses or individuals at a ridiculous price that is significantly lower than the value of those assets. So in this situation, can we say there is an element of government grant embedded in the transaction?
Yes, sir. If the rateable value or the market value of that property is totally at variance, especially below, higher than what actually government has sold it for, it then means that it can be implied that there is a component of that land or property or asset that is non-monetary grants, and therefore such should be measured at fair value. By the time you measure that portion at fair value, it will bring the entire value with the cost you pay to reflect the true value of that asset, which then means that if an asset, a land that goes for 100 million, government sold it to you at 60 million. Now, what we are going to say is that actually you bought a land, a portion of the land for 60 million. And the other portion is a non-monetary grant given to you by government, which have to be measured at its fair value. At the end of the day, you are reporting in your books 100 million, but of which you pay cash of 60 and you got grant of 100 of 40. Does that make sense?
Yes, sir.
Okay, thank you. Any other question? Now, I want us to look at grants in form of below market interest rates. When government gives companies grant at below market interest rates, what happens in that situation? Have you ever experienced it before?
It happens, but personal experience, no. But I know it does happen.
Okay.
Government agencies give grants.
I won't use the obvious example in Nigeria currently because that is spoke out of our discussion, which is the one given to for agriculture, for those people that venture to agriculture. They call it anchor borrowing or something like that. Okay, but that is similar to that. Okay, now, but let's look at how we account for government loans given to a business or an entity at below market rates. Okay, can somebody take us through?
Okay, I would like to do that.
Okay.
Accounting for loans from government with a below market rate of interest. The board identified an apparent inconsistency between the guidance in IAS 20 and IAS 39. It related to the accounting for loans with a below market rate of interest received from a government. IAS 20 stated that no interest should be imputed for such a loan, whereas IAS 39 required all loans to be recognized at fair value, thus requiring interest to be imputed to loans with a below market rate of interest. The board decided to remove this inconsistency It believed that the imputation of interest provides more relevant information to a user of the financial statements. Accordingly, the board amended IAS 20 to require that loans received from a government that have a below market rate of interest should be recognized and measured in accordance with IAS 39. The benefit of the government loan is measured at the inception of the loan as the difference between the cash received and the amount at which the loan is initially recognized in the statement of financial position. This benefit is accounted for in accordance with IAS 20. Noting that applying IAS 39 to loan retrospectively may require entities to measure the fair value of loans at a past date, the board decided that the amendment should be applied prospectively to new loans.
Okay. Now, the reference there to IAS 39 also as of today will be probably referencing IFRS 9, but the reason why they are still referencing IAS 39 was that it was when IAS 39 was in existence that that amendment to IAS 20 was made. Okay. Now let's look at, in practical sense, how that is being done. How do we treat government loan at below market interest rates? You can further your readings.
Government loans at below market rate of interest. The benefits of a government loan at a below market rate of interest is treated as a government grant. The loan is recognized and measured in accordance with IFRS 9, or for entities that have not yet adopted IFRS 9, IAS 39. The benefit of the below market rate of interest is measured as the difference between the initial carrying amount of the loan determined in accordance with IFRS 9 and the proceeds received. The benefit so calculated is accounted for in accordance with the general principles of IAS 20. The entity is required to consider the conditions and obligations that have been or must be met when identifying the cost for which the benefit of the loan is intended to compensate. The requirements of IAS 20, paragraph 10A described above are applied prospectively to government loans received in periods beginning on or after 1st January 2009, or earlier if the entity chooses to apply the requirements from the earlier date. The requirement for prospective application was intended to avoid the necessity to measure the fair value of loans at a past date. For government loans received in periods before IAS 20, paragraph 10A was applied, IAS 20, paragraph 37 stated that loans at nil or low interest rates are a form of government assistance, but the benefit is not quantified by the imputation of interest. Therefore, prior to the application of IAS 20, paragraph 10A, entities did not quantify the benefit inherent in government subsidized loans. And the only requirement was that the nature, extent, and duration of such loans be disclosed if necessary, in order that the financial statements not be misleading.
Okay. Thank you very much in that respect. Now, I think we could now close all of our discussion by looking at what is required to be disclosed. What is required to be disclosed when you are faced with government grants. Now, the first one is that by way of accounting policy, you must disclose the policy you adopt, and the policy range from the method of presentation. Is it the method where you recognize the liability by way of deferred income, or the presentation method where you show it net of the asset costs? You also have to disclose the nature and the extent of government grant recognized in your financial statement. and any form of indication of any form of government assistance, whether through regulation, through government policies, or thereof, as they directly benefit. But if it's a general policy that affects the industry at large, not unique to you as a business, that will not be seen as a government assistance in that case, because naturally government is there to provide that enabling environment. But if the government is now going further to providing some specific assistance to you as an entity, would benefit you directly, that should be disclosed in the financial statement. And for government grant that is asset related, which means you have future conditions that have to be fulfilled. At every year end, where you see a future condition, those conditions will be considered unfulfilled conditions that are yet to be fulfilled. In principle, such have to be disclosed with respect to that. And also, any contingencies that may be triggered by you not fulfilling that condition as at when it is required or as at when it falls due, such also have to be disclosed with respect to the government grants and government assistance. And these are the position of the standard. Now, to much more elaborate on it, I'll also provide information that speaks to guidance from the standard with respect to you making appropriate disclosures in your financial statements. And upon reading that, we'll call it a day. Okay, over to you.
Okay, disclosure. IAS 20 requires the following disclosures in respect of government grants. The accounting policy adopted for government grants, including the methods of presentation adopted in the financial statements, the nature and extent of government grants recognized in the financial statements, and an indication of other forms of government assistance from which the entity has directly benefited, and unfulfilled conditions and other contingencies attaching to government assistance that has been recognized. When grants relate to income, the standard suggests that one, separate disclosure of a grant may be necessary for a proper understanding of the financial statements, and two, disclosure of the effect of the grant on any item of income or expense that is required to be disclosed separately is usually appropriate. Separate disclosure should, in particular, be considered when a grant has been netted against the related expense in profit or loss.
You can continue.
Okay. IAS 20 also requires an indication. IAS 20 also requires an indication of forms of government assistance other than government grants from which the entity has directly benefited. Although the benefit resulting from such forms of assistance may not be measurable, the impact of items such as free technical or marketing advice or guarantees should be disclosed where it is significant. Even though such assistance is not recognized as income in the financial statements, it may benefit the entity to such an extent that disclosure of the nature, extent, and duration of the assistance is necessary for the financial statements not to be misleading.
Okay. Thank you very much. Now, I wanted to share something that will assist us in the discussion. Okay, we've discussed it, but probably show us some practical perspective to it about treatment of government loan at below market price. Now I'll give us a practical example to that, and I'll share that with you guys. Can you proceed to reading this?
Okay.
Can you read it? Yeah.
Government loan at below market rate of interest. Example, Entity Q receives a loan of 3 million CU from the government. The loan is at 2% interest and is repayable in 5 years. Using prevailing market interest rate of 5%, the fair value of the loan is calculated at 2.6 million CU. Under IFRS 9, or for entities that have not yet adopted IFRS 9, IAS 39, the loan is recognized at 2,610,347 CU. The difference between this amount and the proceeds received of 389,653 CU is the benefit derived from the below market interest and is recognized as deferred income. Therefore, on the date that the loan is received, the following journal entry is recorded. Cash received will be debited, and that will be 3 million CU. We credit government loan by 2,610,347 CU, and we credit deferred income, that is government grants, by 389,653, and the narration is initial recognition of loan at below market rate of interest.
Now, continue. Let's see how we now recognize it going forward.
The interest expense is recognized in profit or loss at 5% in accordance with IFRS 9 or IAS 39. Do I need to talk about the schedule?
Yeah.
Okay.
Just narrate the schedule since you've done financial instruments.
Okay, so we have the schedule with the opening balance of the loan, the interest calculated at 5%, and the interest paid at 2% plus capital repayments in 5 years. Then we have the closing balance. So we add the interest of 5% to the initial opening balance. Then we reduce the payment for that year, which is 60,000, to arrive at the closing balance. And you know the closing balance will be what will be reflected in the second year. Then we continue on and on like that until we get a new value in year 5. So in accordance with IAS 20, the amount of the government grants 395,653 CU is recognized in profit or loss on a systematic basis over the periods in which entity Q recognizes an expense or recognizes as expense the related cost for which the grant is intended to compensate. The cost for which the below market interest rate is intended to compensate are assessed on the basis of the particular circumstances. For example, the loan may be intended to subsidize training costs over a 3-year period. The cost may be incurred on a straight line basis, in which case the government grant will be released to income on a straight line basis, that is 129,884 CU, which is also equivalent to 389,653 CU divided by 3 each year for the 3 years. The loan may be intended as a rescue measure for the purpose of giving immediate financial support. In such circumstances, under IAS 20, it may be appropriate to recognize the benefit in profit or loss immediately. Or 3, the loan may be intended to finance a depreciable asset. In this case, the benefit will be recognized on the same basis as depreciation.
Okay, thank you. Thank you very much. Now, let's try and model it so that I want us to refresh our memories of financial instruments. Let's model it. Let me take a switch. Okay. Now let's build our model. Loan amount. 3 million. Contractual interest rates. %. Market interest rates. If the loan supposed to have been taken without such a grant or an assistance. Now, the loan is such that you will repay it in 5 years, but you only be financing the interest. Therefore, loan type. Is this amortizing loan or loan where you make a balloon payment at the end of the maturity or at maturity? It's a non-amortizing loan or a loan that pays balloon principal at the end of the day. Okay, now, what is the cash flow pattern? Year one, what's the tenure of the loan? 5 years, which means that. Duration. Loan tenure. Five years. Okay, year 1 to 5, interest. And year 5, principal. Okay, now let's estimate the value. Interest is a product of what? It's a product of 2% and the 3 million. Let me put this in there. Okay, why the principal is the 3 million? No problem. Now, let us find the fair value of the loan. The fair value of the loan is for us to discount the cash flow of the loan over its life with the market rate of interest. Take note. This is critical. I'll put it in red. Remember, these are derived. Okay, therefore, what's my fair value? My fair value is for me to use the PV function in the Excel. I need my rate. The rate I'll use to discount is going to be the market rate. I need my tenor. The tenor is 5 years. What is the payment you make each year? The payment you make each year is 60,000 as interest. And what is the future value? Is the principal you pay upon maturity. And what is the type of the loan? Is it in arrears, will interest be paid, or in advance? Naturally, interests are paid in arrears, except otherwise stated. I'll put 0. And if it's in advance, I'll put 1. If you remember, then it means this is the fair value of the loan. This is how they got the fair value. Do you get it now? This is the fair value of the loan. Now, what will be the accounting entry first? Now, upon receiving the loan, you debit your bank with the 3 million and you go to your liability. You come here, non-current liability, you have loan. 2% loans. That is non-current liability. And that's how much at fair value, 2.6. The balance will be recognized also as liability, but in this case, is a government what? Grant. One is government loan. One is government grant. And the grant will be the difference between this and this. Now, how do we now determine our amortized cost schedule? Yeah. Amortized cost at start. Interest at our effective interest rate will be the market rate of 5%. Our cash flows and our amortized costs at the end. What's the loan amount? At fair value. And forthwith, interest is recognized at 5% of the outstanding balance. And the cash flow is the interest you'll be paying on a monthly, on a yearly basis, 60. And at the end of the day, your amortized cost at the end is your initial balance plus interest accrued less amount paid. And that balance will be carried forward. And once you do that, you find out that at the end of the day, you have now the sum of 3 million that is due for payment immediately. And if you are paying it with the last interest, it then means you come here to say it's not only the interest you are paying, but you are paying interest, final interest and principal will go hand in hand. And at that time, you have extinguished your loan. And that is it. That is from the angle of the loan. Now, we'll now use the same systematic basis to amortize this amortized schedule for loan. Now, what basis are we going to use for the government grants? You use a systematic basis also for the government grants. But if I want to use a basis for the government grant, what I would do is to compare the difference between the 5% and the 2%. Do you get what I'm saying now? Okay, can anybody do that now? Let me give you 2 minutes to look at it and propose something for us. The standard requires us to recognize this grant on a systematic basis over the period to which we expect we need to fulfill the condition of that grant. Now, systematic basis to reflect the similar basis to which what the grant tends to achieve has been more or less achieved by the organization. Now, if you look at the example given in what you guys read earlier, it says that that loan initially was incurred for the sole purpose of, let's say, training-related costs for human capacity development. And that is expected to span for a 3-year period, even though we took the loan for 5 years. Once the 3-year period, the training capacity is being fulfilled, government can no longer more or less seek repayment of that grant because you have fulfilled all of the conditions at the end of year 3. Invariably, what will happen in that case is that if the grant is so much at 389,652.99 kobo, you will have to now more or less amortize it over a 3-year period, for example. And if you do that over a 3-year period, it means in 3 years, you will have fully amortized it. Do you get what I'm saying now? If it's 5 years, it then means that your full amortization will have been in 5 years. Which means you as an organization knows the reason why government gave you that grant. And as you perform those conditions, use a relative basis that reflects the degree of the performance of those conditions to amortize your grant income over time. Does that make sense? Which means you amortize, which means grant income every period will be 77,939.58 kobo over a period of 5 years. Does that make sense now?
Yeah.
Yes.
Okay. Okay. Any other question? In the absence of question. Therefore, it means we can call it the end of our discussion on government grant. Okay, I'll put it here to support the discussion earlier. So, okay, thank you very much. And God bless you guys all.
Thank you, sir.
Thank you, sir.